So this is the question. First of all, whenever you people are doing in your exam the question, so first of all, try to go through the requirement of the question. The requirement of the question will tell you people that actually the question is on which topic. So it is giving you people a confidence. Okay. Calculate for the two scenarios the funding required for the acquisition of P company. So first of all, from this requirement, you people can see that the question is for the acquisition and mergers. That you are going to acquire the target company, the P company, and examiner is asking how much funding will be required for that. Then impact on M company earning per share. The M company must be the acquirer. Examiner is asking what will be the impact on the earning per share and the impact on the gearing. So these are the 9 marks, the 3 marks for each part and entire calculations. Then if the acquisition was to take place, discuss the concerns that M company shareholders may have about the EPS, gearing levels, and the control of M company. So now this is a purely theoretical portion. The examiner is asking if the acquisition was to take place, discuss the concerns that M company shareholders may have about. So if the acquisition will go ahead, we have to show the impacts on, discuss that the impacts on EPS, gearing, and the control of the M company. Now in this question, examiner has also asked, discuss the regulatory and governance concerns relating to the promises required by Peter and Patrick. So when you will go through this question, actually the Peter and the Patrick, they both are the owners of the target company. So you can say the target company is being run by the two guys that are the Peter and the Patrick. They are the owners of that company. So we will see that what issues they are having. So examiners is asking, discuss the regulatory and governance concern relating to the promises required by Peter and P. So professional marks will be awarded for the demonstration of skills, analysis, evaluation, and the skepticism uh, and commercial acumen in your answer. So let's talk about now the question. You can see, guys, the question.
Yes.
M company is a leading bus operator in W, operating bus services in the country's south and central regions. M company's board is keen to expand its business operation into the other regions. Like currently they are in the south and central region. Now maybe they are trying to move into the west or east regions as well. And also would like to gain franchises to operate trains on these rails network. So now they want to expand their existing business as well as they want to go for diversification. They want to go for a railway business as well. For this, they are trying to have the franchise. M company board has identified P company as an appealing takeover target. So in this question, the M company is the acquirer and the P company is the target. Now, P company operates the bus service in Slovenia's north and east regions. So now see, when they both will be combining, what will happen? This company was in the south and central regions. The target is in the north and east region. So you know now a big market share will be there. And also a franchise to run local train service in the east region. So this company, why this is appealing for the acquirer? Because when the acquirer is going to acquire such company, the M company is going to acquire P company. So the group will be having a combined presence in the south central regions as well as the north and the east. And then this company, the acquirer was very keen that they want to gain the franchise to operate trains. So this company, the target, is already having a franchise to run local train service in the east. So this will be a beneficial for the acquirer point of view as well. Now, P company in common with other retail companies has recently faced pressure from government to enhance investments in trains and staffing in order to increase customer satisfaction. So very important point that the target company is facing the pressure from the government. And the government is saying that they should invest in trains and staff because of the customer satisfaction. M company's board believes that P company will struggle to meet these demands with the resources it has, and therefore its directors will be open to take over offer from M company. So now it is a very good point. The acquirer is saying that whatever the resources the target company is having that are not sufficient. So as the resources are not sufficient, so they will welcome if another company is going to buy them. Therefore, directors will be open to a takeover offer because they are not having the required resources so that they can meet the pressure by the government. So both companies are listed on stock exchange. M company has a range of institutional and the small investors. The institutionals mean that the big giants are there and the small investors are also there. But with no shareholder holding more than 12% of the shares in the company. So this is the M company data that has been given. 45% of the P company shares are owned by the brother Peter and the Patrick, who are respectively chief executive and operation directors of P company. So what the examiner is saying, in the P company, there are institutional as well as smaller investors with no shareholder holding more than 12% of the shares. But 45% of the P company share capital is owned by the two brothers. Now, M company boards believes that its investor will be concerned about the future earning per share if the acquisition goes ahead and how the earning per share might differ between the two possible scenarios which the board is looking. They would be sensitive about any increase in gearing levels and the implication for control of the company of introducing the new shareholders. So now what is happening? The acquirer is concerned about some things. The first thing is if the acquisition will go ahead, what will be the impact of the future earning per share? Then when the acquirer is going to acquire the target company, there will be new shareholders there in the group. So what will be happening? The control of the company of introducing new shareholders and what will be the gearing levels. The Thulam brothers have discussed between themselves. Now these are two brothers which are there. The Thulam brothers have discussed between themselves the possible terms of an offer from Meplash company. They have decided that they would consider accepting a share offer provided they were promised executive directorship on the combined company board with a package at least equivalent to what they were currently receiving and service contracts for 3 years. So now what is happening? The target company, the 45% shareholders, which was the two brothers, as they are the majority shareholders, what they are saying that the acquirer should offer them a promise that in the combined company, they both brothers will be on the executive directors and the company will be offering them the same what they are currently offering. The combined company will be giving them the same package what they are having now. And they must be having the service contract for 3 years. Any financial impact of uh, Tulams become executive directors should be ignored in the calculations. Okay. Now, you have been provided the profit before finance cost and tax for acquirer and target. The finance cost, profit before tax, the tax, profit after tax has been given. Number of shares, earning per share, price to earning ratio, market price per share, long-term liabilities, then the gearing formula has been given, and then the cash and cash equivalents has been given, and then the industry average gearing is given as 30%. So this is the all the data that has been calculated by the examiner, and this has been provided to you. Now, this is a very, very important paragraphs which you have to go through. Try to understand this paragraphs. M company's board in is considering giving P company shareholder the choice between 2 shares in M company for 3 shares in Pi company. Mean the first offer the acquirer is giving, that is the share for share offer, or a cash alternative 2.75 for each Pi company share. So in this question, what is happening? The examiner has given you the 2 offers. One is the share for share and one is the cash offer. But in this question, examiner has tested these offers in a different way. Try to understand now. M company board is contemplating the 2 possible scenarios. This was the 2 possible scenarios which the examiner asked in the first requirement of the question. All P company shareholders accept the cash offer. All P company shareholders accept the share offer. So these are the 2 scenarios. Annual post-tax synergies from the mergers are expected to be 8 million. The combined price to earning ratio is expected to same as M companies was before the acquisition. Okay. Now, this parts which have been given now, that is very important. Cash payments for shares will be funded firstly by the balance of cash and cash equivalents held by M company of 102 million. What the examiner is saying? Cash payment of shares. If the acquirer is using the cash offer, so from where that cash is coming? Cash payment for shares will be funded firstly by the balances of cash and cash equivalents held by M company of 102 million. Assume that return on cash surplus with M company could make a 6% pre-tax return. So what will happen, guys? When this cash and cash equivalents you are going to pay as a cash offer, so this return which was previously being earned, that return will be lost. Understanding my point? Tell me.
Yes.
Now, the balance of the cash requirements for the cash payments for shares will be funded by a debt at a pre-tax cost of 9%. Now, it's mean that, for example, for the cash payment, what is going to happen? If $100 was required, the 50 we are getting from the cash equivalents and the balance we will be having from the debt. And if you are having from the debt, upon that we will pay how much? 9% interest. Understand?
Yes.
Assume existing debt of P company will not be taken on by M company and not paid off using the balance of cash and cash equivalents. Existing debt in the balance sheet of the target, whatever the debt is, the acquirer is not going to pay that. And that P company's balance of cash and cash equivalents will be maintained in the merged company. This is the assumption. Tax is payable at an annual rate of 25% on profits of both companies. So now let's solve the question. What was the first requirement? The first requirement was the funding required for the acquisition of P company. This was Okay. Both of you have opened the question.
Yes.
Hima, have you opened the question? Hima, your voice is very low.
Everybody is sleeping.
Give me 1 second. Okay. Now, first of all, you will tell the examiner that A part of the question and funding required. I need both of you to tell me. First of all, we have to tell the examiner if you are funding 100% cash. What was the number of shares of the target company? Tell me. Number of shares?
150.
150.
Yes.
And its per share price was what?
2.42.
I am asking about the target.
Yeah, it's 2.42.
Okay. You are saying but see what the cash we are offering them. What was the offer?
75.
2.75. As we are calculating the bid, so we set them for 150 number of shares. Per share, we are offering them. What was the offer value?
2.75.
So, how much cash is required? $413. This is required.
Yes, sir.
And examiner told you people that when you are having the cash, so this will be paid with the cash and cash equivalents.
Yes.
So how much the cash and cash equivalents are available of the acquirer company, of the M company? How much?
102.
So it's mean that if 413 million is required, out of that 102 cash is available. So how much is the balance which we will have from the debt?
310.5 or 311.
413 minus 102. This is
3,
311.
31.
This
Yeah.
is the debt required. So if I say to you people in an easy word the total funding required was 413. Out of that 102, we are paying with the help of the cash, and the balance 311 with the help of the debt. Okay?
Yes.
Yes,
Sir,
Seema.
1 minute. Sir, why we are not deducting the cash and cash equivalent of target company?
It was stated in the question that for the cash offer, which cash equivalents will be used? The acquirer. The
Okay.
cash payment for share will be funded by the balances of cash and cash equivalents held by M company. And the balance will be funded by a debt. Understand?
Okay, got it.
Now, this was if it is 100% cash, but in this question, there was cash offer as well as share
Beautiful.
offer. So the cash offer we solve. Now, let's talk about if it had been 100% shares. So under the share offers, guys, as in the share offer, the share exchange is there. Acquirer is issuing its own shares for the shares of the target company. So you will just tell here, no extra finance required. No extra finance required. Because examiner told you that for the cash offer, you are having from cash and cash equivalents and the balance will be where? Debt. But in the case of the share offer, no extra finance will be required because target company shareholders, they will be having the share for share offer. The acquirer is issuing its own shares for the shares of the target company. That's it. So the A requirement of the question, what was that? The requirement was the funding required. So how much funding? We have told. In the case of the cash offer, the total, now, in the case of the cash offer, the total cash required was 413. Out of that, the 102 we were having from the cash and the funds required from the markets, they were 311. But in the case of the share offer, no extra funding is required. Understand?
Yes.
Now,
Yes.
examiner was asking the impact on M company earning per share. And again, for two scenarios, each work you have to do for the two scenarios. So very easy. What is the problem? Try to understand. The second part, you have to compute impact upon EPS. But again, if it is 100% cash or 100% shares. Now try to understand. Earning per share. Okay. Guys, in this question, what is the formula for the earning per share? You will take profit after tax divided by
Number of shares.
Number of shares. But try to understand. Guys, these earnings, the profit after tax, this should be for a single company, mean for the M company or for the combined group. Because with this 100% cash, what you are doing? The acquirer is giving cash offer to the target. With the shares, what is happening? Acquirer is giving share offer to the target. So the earnings should be for the combined company. Understanding my point? So, Hema and Zenith, I told you people,
Yes.
when in the question you have been provided the synergy per year. So what was the formula to compute this combined earnings? What was the formula?
P ratio.
No, combined earnings. Tell me.
Acquirer plus acquiree plus synergy and multiply by group P ratio.
Yes, yes. There was the first step was combined earnings, and then in the second steps we were computing the combined market value. But here I am first talking about the combined earnings. What will be the formula? Earnings
Earning
of acquirer. What was the profit after tax that has been given in the question for the acquirer?
it's 60.
60. What was the profit after tax for the target?
33.
33.
What was the synergy benefits?
It was
8 million.
8. Yes.
But now this is being affected by the scenario given. What was that? As we said, in the cash offer, this we are having this balance from cash and cash equivalents. These cash equivalents were giving you people the 6% return. It has been stated in the question. So now,
Yes.
as we have utilized these cash and cash equivalents, so this return will be lost. So 102 into 6% and make it after tax. That
0.75.
so 0.75. So what will be your return lost? It will come as 4.59. This you will deduct from here, 4.59. And now, what is going to happen, guys? Upon this debt, you are also going to pay interest. How much was that interest?
6%.
9%, not 6%. 6% was for cash and cash equivalents.
9%, yeah.
So 311 into 9% into 0.75. How much? 20.99. So this interest will be deducted 20.99. So what are your revised earnings now coming? How much?
$75.42.
You tell me.
75.42.
Okay, as this was a cash offer. So I told you people, in the cash offer, what will happen? When the target company shareholders, they will take the cash, they will leave the company. So after acquisition, how many number of shares will be there in the group? Tell me.
10 shares.
How much? Tell me. What are the acquirer number of shares?
200.
Only 200 number of shares would be there. Do you remember?
Yeah.
In the cash offer, what happens? Acquired shareholders are valid after acquisition. The target shareholders are no more valid. The target shareholders, they will take the cash and they will leave the company. So how much will be now revised earning per share? Tell me. 75.42 divided by 200. 0.38.
0.38.
This is your revised EPS. Now, in the case of the shares, what will happen, guys? Now, my question from both of you. In the case of the shares, what will be your earnings, guys? 60 plus 33 plus 8. No more 4.5 and 2.9. Because
Yes.
this was in the cash. This was having in the
Yes.
cash equivalents and the balance you are having from the debt. Here, no. So what are your revised earnings coming?
101.
101.
1.
Now what are the number of shares? You know, in the shares for share offer, what I told you, the share acquirer number of shares will be there and the target number of shares you will compute by the share exchange ratio. So the acquirer number of shares 200 and the target number of shares were, what was the target number of shares? 150.
150.
And we are offering him 2 shares for 3 shares of the target company. So how much total number of shares, guys? The total shares will be how much? Total shares after acquisition
300.
300. So
Yes.
101 over 300. How much will be the EPS?
0.34.
0.32. So try to understand, Zenat. Still the
Yes.
concept is the previous. Just examiner tested in a different angle.
Yes.
Okay? Yes.
And we are doing the 2/3 ratio. The answer coming is 100.
So 100 of the target, 200 of the acquirer. So total 300.
Yes.
Okay. Now we have showed the impact on funding requirements on the EPS. Now we have to show the impact on gearing. Impact upon gearing. What formula the examiner has used? Debt divided by debt plus equity. Again, 100% cash and then 100% shares. So tell me, guys, see in the Data given. What was the debt of this company? Tell me. Acquired debt, how much was that?
285.
285.
Yes.
What was the debt of the target company? How much?
225.
225. And in the cash offer, we have already decided how much debt we are having from
311.
311. Divide by 285 plus 225 plus 311. Now equity. Guys, can you tell me how you are going to compute the equity? It is a
It's
cash offer. Which
Yeah.
shares are valid?
acquired.
Only acquirer shares are valid.
Yes.
How many number of shares are acquired?
200
200. Then
into 3.96.
into?
3.96.
Okay, now see, again examiner was very sharp. What you are saying? What you are saying, miss, tell me, which price you are saying?
3.96.
Now try to understand my point. This 3.96 was given where? In the data given?
Yes.
But this 3.96 was before acquisition.
Okay. Mhm.
Now, there should be a price after acquisition. Okay. So, now see, we can compute what was the price to earning ratio formula.
Market
Market value
value per share.
over EPS.
Yes.
The examiner said that the price to earning ratio will remain same as of acquirer company after acquisition. What was the price to earning ratio given?
At 13.2.
13.2. The market value we have to find. EPS we have find. How much was the EPS?
0.38.
So tell me. 13.2 into 0.38. What is coming?
5.02.
This is the market value per share after acquisition. This you will utilize. So tell me now, whatever the answer is coming, multiply by 100. How much is this coming?
In every case, we will take this after acquisition price.
The pre-acquisition price we cannot compute here. If it had been a question that examiner is asking, compute the current gearing, then you can use. It is when you are following the two scenarios, the cash and the share for share offer. So every time you have to keep in mind that the companies are being combined. So you have to use that values. Why we are using this value? 285 and 225. This was the value for acquirer. This was the value for target. So it's mean that here should be a price that is a post acquisition price. So what is this coming?
44%.
Now if you have to follow the shares, what will happen? 285 plus 225. Whether the 311 will be there? No.
No.
So divide by 285 plus 225. Now tell me how much number of shares would be there?
300.
300.
100.
And miss, now you tell me, both of you, what share price will be valid?
Post acquisition
What was that?
5.2.
No, no, no. Again, examiner tried that.
I have to compute.
Again, we
Agree.
will compute because
Okay.
in the share, what was happening? The EPS was changing.
Yeah.
So again, what will happen? Again, apply the price to earning ratio formula. Market value you have to find. EPS was there. So this is X. This is 13.2. And the earning per share under the share offers, how much was coming? 0.34. So 0.34 into 13.2. What is the X value coming? How much?
4.49.
So this value is 300 shares into 4.49.
49.
And then all of this multiply by 100. How much?
And calculated.
How much?
4.49. Can you show that step?
Simply, you had to compute the revised price.
Okay, what?
Revised price or price after acquisition. Okay. What is this coming?
27%.
27. Now, I am going to clarify your point. Like, you must be having a point, sir. Previously, you told us that the post-acquisition price per share in the share for share offer remains same for both. Do you understand what I'm
Yes.
trying to say? But what was happening? See, this was the cash offer. In the cash offer, I told you people, the post-acquisition price is only valid for acquirer. For the target company, the offer value is valid. And in the case of share for share offer, the same share price after acquisition per share is valid for the acquirer and the target. Understand? What was happening
Yes.
in this question? See, again, I am recapping all of my data. Your originating point was this one, the cash and the share. In the previous examples, examiner tells you that for the target company shareholders, Like in this question, examiner said against 150 shares, we are paying them 2.75. Okay. So the cash we had to pay them, this was, but examiner said out of that, you will pay 102 from your already having the cash and cash equivalents, and the balance will have from the debt. So these impacts of cash and debt we had to show everywhere wherever the cash was there. Like we impact on EPS. So EPS is a part of profit after tax and the number of shares. But remember, with the help of the cash offer, you are going to acquire that company. So you have to compute the combined earnings. And again, in the earnings, you have to show previously you are earning the interest on that cash equivalents that will be lost it. And you are going to have the debt, upon debt, you are going to pay interest. So our earnings are this one. In the shares offer, what was happening? Our earnings are changing. So that is the reason, because here our earnings are changing. The previous questions which we have solved, they are like the Nanti company, the Sigra company, the Havco company. What was happening there? What was happening? We were computing the combined market values. Do you remember?
Yes.
The combined market value, it was same. Like we have computed here the earnings of acquirer 30, earnings of target 50, plus synergy was 40. So 120 are your earnings, combined earnings. And then we said for combined market value, these earnings will be multiplied by price to earning ratio of group or acquirer. Let us assume that was 8. So how much is this coming? 80, 960. Now, see, this 960, the combined market value we were using in our cash offer, in our share offer. What was happening? In that questions, our earnings were not changing. Okay? But in this question, what is happening? Our earnings are changing. You can see in the cash, due to the incorporation of this cash and cash equivalents and the debt, our earnings are 75.42. And here, as this was a purely shares, our earnings are 101. So if your earnings are changing, what will happen? This price will automatically change. Understanding my point?
Yes.
So this was a like of the best calculation, I will say, which the examiner had tested. Good question.
Yes.
As this earnings are changing, right? Okay. Then if we will do the share for share offer and cash for cash offer gain,
Hmm?
percentage gain,
Hmm?
will this affect on that?
See, in this given question, if you have to compute the gains, okay, for share for share offer for the acquirer and the target. So what will happen? Like first we say that the examiner is asking the percentage gain for cash offer. Okay. First of all, you will state here their existing data. Okay, let me hold on. Because otherwise, now see, the practical portion was very important. Both scenarios give a high earning per share figure, with the cash based figure giving the highest amount. Mean, if you compare it with your existing EPS, so with your what was your existing EPS that was there in the question?
0.3 and 0.22.
Okay. So what the examiner is saying now, see, we have computed the EPS under the cash offer and under the share offer, and they both are coming as 0.38 and 0.34. So it's mean that with cash based figures giving the highest. However, shareholders are likely to be concerned about the risk return balance of the acquisition. M company will be acquiring extra debt and extra finance cost, but there may be insufficient income to cover the extra cost. What is happening with the cash offer? What was happening? Previously, on the cash and cash equivalents, we were getting the returns. That returns are also lost it. And also we are going to have the debt amount. On that, you have to pay the interest. So examiner is saying for the acquirer, there may be such an issue that from where the acquirer is going to pay this cost. Because already the acquirer is having the low cash balance, due to which the acquirer is going to have the debt, and now upon that the acquirer has to pay the interest. So again, this may create a burden. And see, whenever you are using there may be insufficient income, do not say here there must be, because if you are using a must be element, you are not applying the skepticism skill. Skepticism is challenging.
Yes.
Now, the profit figure used in the calculation may be from an above average year for P company. The P company business is likely to face pressure on its earnings and cash flows due to increased investment required in trains. You know, it was stated in the question that the government is pressurizing the target company to invest in trains and to recruit staff so that to meet the customer satisfaction. So examiner saying the profit figure used in the calculation may be from an average year, above average year. Both companies also may be affected by other environmental factors. For example, a switch in travel towards the private car. Profit in the share offer scenario will also be affected by whether the three are appointed as executive directors and receive a large remuneration package. So now examiner is trying to link whatever the data was given. You know, the Thomas and the Patrick, they brothers, they had the demands that in the combined company, they should be offered the executive positions as well as whatever they are currently having as a remuneration that should be there, and the service contracts. So examiner is saying first effect is that both companies may be affected by environmental factors. For example, a switch in travel towards the private car. People, they may start not to travel by the trains, they are traveling by the cars. Or profits in share offer scenario will also be affected whether they are appointed as executive directors and receive a large remuneration package. You know what will happen? In the cash offer, they will take the cash and they will leave the company. But in the share for share offer, you know the target company shareholders, they are also the member of the combined company. But to convince them upon this basis, that may be a problematic. Shareholders may also about the basis of calculating the synergy figure. You know that in this question, the 40 million synergy was there. Given that P company operates in a different region of Malpesh company and also operate train wheels, Meplash company operate buses, the operational synergies look to be limited. Although there may be a scope for administrative synergies, increased demand placed by government on P company's train operation as regards staffing level may also limit synergies. So now see, examiner is telling you people that until unless you people do not learn the linkage of the data to the case study given, what was happening? Examiner is saying this, the synergy is having the types, the revenue synergy, the cost synergy, and the financial synergy. Okay. So examiner is trying to make you understand the operational synergies look to be limited. Although there may be a scope for administrative synergy, increased demands placed by the government on P companies' train operations as regards staffing level may also limit synergies. What will happen? The government is pressurizing them. The government is pressurizing the target company to invest in the trains, to have high staff levels that may limit the synergies benefit realized. Now, both possibilities results in increased gearing. Although if the share offer is 100% taken up, surplus cash could be used to pay off some debt and reduce gearing if a sufficient payment was made. Very important point. Examiner is saying if the company is using 100% share offer, so if the surplus cash is there, so what will happen? That cash maybe the company is utilizing to pay off the debt. If the debt will be paid, automatically the gearing will be reduced. Shareholders are likely to be particularly worried about the large increase in gearing that a take-up of cash offer will mean. What was the gearing coming, guys? The gearing under the cash offer, how much was that?
44%.
So our industry average is 34%, and under the cash offer, it is coming as 44%. So this, whenever the gearings are increasing, the investors, they are seeing the companies as a risky investment. So the shareholders, they may be also demanding the higher return. So there is likely to increase the cost of equity. So they will be concerned with the term of paymore's company debt, whether any debt due for repayment will be renewed, or if not, how it is likely to be repaid. So, in the data given, the debt of the target company has also been there. So what will happen with that debt? Whether in the combined company, the company is going to pay that debt, or whether the debt will be renewed or not. Shareholders will also be concerned about how the investment required in the train will be funded and long term, and how planned further expansion will be financed. Further debt finance might increase gearing to unacceptable levels, but alternative may be an equity issue, meaning current investors having to make a large payment if they are to maintain their percentage shareholding. It is possible that increase in gearing would cause investors to question whether other opportunities which would not involve taking on so much debt might be better. So again, what is happening? When the group is combined, so government was pressurizing to invest in the train. From where the finance will come? Because already the target company, with the help of the cash offer, is financing. But when the group is combined and the government is pressurizing, so whether the now the combined company will be going for again a debt financing because the company will be a short of cash. So the further debt will again increase the company gearing level, and again the shareholder will be concerned. But the other option is if they are going for the equity. So remember, guys, if I will add a point here, the equity is not a cheaper source of finance. The equity is a costly source of finance as compared to the debt, because on the debt, the companies, they are having the interest payments, and the interest is a tax allowable expense. So this you should also keep in mind that after the combination, still the investment in the train is required, and the shareholders will be concerned about that. So now the control. Investors may be concerned about the fall in percentage of holding if shares are issued 1/3 of Meplash shares will be held by P company shareholders if the shares offer is fully taken up. What was that offer, guys? The acquirer is issuing its how many shares? 2 shares for the 3 shares of the target company. Current shareholders may be concerned about the holding of the T brothers. Between them, they would hold 15% if the share offer is fully taken up. Because the total number of shares were in the combined group 300, and they currently own in their own company 45% shareholding, and they want the same terms and condition. So out of 300, 15% shareholding will be still to them. The block of shares they would hold between them would be higher than any individual investor currently holds. So Meplash company investors will see this holding also in the context of the T brothers exercising influence over the company if they are appointed to the senior management role. Very good point. What the examiner is saying, if the terms and condition which they are having previously in their own company, they are having the 45% 45% shareholding. So now what is happening? If out of 300, we are giving them the 45 shares, they are the 15% shareholder. So they both is creating, you can say, a monopolic power. They will be in a position to exert some influence over others. They may have undue influence. So that's why the shareholders are concerned that when they are giving the management responsibilities, so what will happen? And now in this question, the C part examiner was asking the regulatory concerns. Any offers made to T brothers would have to fulfill regulatory requirements. First of all, this could well include transparency, with the T being required to disclose immediately any offer they had received and perhaps not being involved in discussion about the takeover. Although this is difficult to envisage given the roles they have on P company's board, an offer to T to become directors could also be held to additional consideration for their shares, breaching the principles of equal treatment of shareholders. So, guys, in the key aspects of takeover regulation, the first rule is that there should be equal treatment between the shareholders and there should be transparency. So, what is the transparency that? Well, they have to fulfill the regulatory requirements. Transparent information should be there, and they are required to disclose immediately whatever the acquirer has offered to them. And but as the principle of equal treatment is there, maybe when the company is having them as a block, they will be having a 15% shareholding. So this is the maybe breaching the principle of equal treatment, and before acquisition, we should keep that in mind. Now, some governance concern. P company shareholders may perceive a conflict between the personal interest and the requirement on them to act in the interest of P company. Now see, this is, you can say, a agency issue. Why the target company shareholders? They will be ready to sell the company because now they are saying that the company is going to be a bigger company in future when they form a group. But the target company shareholders, they may be having an overview that after selling the target company, these brothers, the 2 brothers, they will be acting not bona fidely. They will be only acting for their own interest, not for the group. So M company shareholders may be concerned about whether T should be appointed to the board. If they perceive P company to have performed worse than Meplash company as regard generating earnings and achieving customer satisfaction. So now The M company shareholders, they are also concerned that these brothers, if they were appointed to the board, what will happen? Government was previously pressurizing them for their customer satisfaction as well. So they are, mean to say, there's a question in that in their mind for the acquired shareholders that this company is a worse performing. They cannot satisfy the customers before. Shareholders are also likely to query what the fees are offered if it appears to be more generous than those given to M companies, other directors, and more generous than their responsibilities warrant. A 3-year service contract, for example, is a longer than recommended by many governance reports. Again, they were requiring the 3 years contract. So the acquired shareholders, they are also considered that whether these directors will be given the more generous terms are offered as compared to the other directors. So the possibly local governance code may not require shareholders' approval of the initial appointment of the brothers to the board or their remuneration packages. So this is against the practice. However, the principle of communication with shareholders should mean major shareholders are consulted before M companies boards takes decision regarding the employment of these wellness companies. So I will say that this was a very, very good question. Okay. The theory was very much interesting.